it's Don Kaufman here doing the weekend update for TheoTrade, October 2nd, 2020. An October surprise comes in out of left field and just damages technology. Although you'll be surprised to find out that tech in the entire marketplace actually finished the week higher. Let's get to work because there's some opportunities, some real setups coming our way inside of the broader marketplace. We'll come to the obvious in just a moment. First and foremost, you got to look back at this past trading day, which just saw absolutely wild ranges. We ended up, again, the S&P's down about 22 handles or 0.6%. The Nasdaq off by the tune of almost 3%. The Dow is flat. The Russell bids up. Again, huge divergences in the marketplace. And we're going to talk about what I would term an unexpected divergence. But I was saying, I want to start with just some of the very, very odd trade that we saw inside of the broader S&Ps today. The marketplace off some of the overnight lows. Rallies, fades, rallies again, very, very news driven. I mean, we were trading pretty much on a hairpin trigger throughout the course of the trading session. One of the broader things, though, I want to pick up that was, I guess, left me kind of hanging over here. If you take a look at the total volume that was traded on the session, and I'm looking, again, specifically at S&P futures, because I think S&P futures are a great way to distinguish, okay, what kind of went on in the broader marketplace. And why? Because this is hedging activity. But see, you have this 75-point range, which is a decent sized range, of course, in the S&Ps. And volume was there. Yeah, we did some 2 million contracts, but it's just not what you expected. Because I'll tell you what, coming in to trade this morning, before the bell went off, we were already sitting at 500,000 contracts. So you mean to tell me we only did 1.5 million S&P contracts throughout the entire cash session? And yeah, that's it. It was, again, it wasn't exactly that, that explosive volume that you kind of look for to say like, hey, it is on. It's clearly not on. But again, this trading day, the only thing you can call it is just absolutely peculiar. You look at the S&Ps and you're like, well, not a whole lot happened. Yeah, then you look over at the Nasdaq and a whole lot happened inside of the Nasdaq. The Nasdaq finished off of the lows of the trading session, but not far off. And again, this entire, sell side activity that persisted here in Friday, it was all about the Nasdaq. Clearly, it was all about the Nasdaq, down about 3%. So let's kind of break down a little bit of some of the action that we saw here. I mean, I'm terming this, presidential COVID. So COVID may really have been the catalyst. And all of a sudden, obviously, okay, the president being, positive COVID, I'd push that aside right now because the aspect that is COVID was the catalyst, but the outcome was sell tech. And there's more questions there than answers. And if I sound a little confused, yeah, you better believe it. Okay. Because tech in every other COVID scare has performed magnificently. And yet today we see this huge COVID scare and you got Netflix getting whacked back after having a huge bid. You got Facebook down 2.5%. Amazon's getting hit. So you have to question if this was even a COVID scare or was this just simply smack everything, okay, that's been extraordinarily bid up as of late. And if that is the case, okay, you got to realize that technology, right, that might be on the chopping block here to see some more sell side activity in the days to come. And this, it just leaves me very, very uneasy. And as I said, okay, there's a trading session once in a while, you get a great feel. Then there's trading sessions that leave you with more questions than answers. And this trading session we just passed through, this is the latter. All right. Again, I would assume that this is a very large COVID scare and everybody's looking at the political implications and trying to pull, definitive answers out of here. But again, the only answer you have right now is, well, they smoked tech pretty hard. And it's not what you would have expected with any type of COVID scare. But maybe this has more to do with, the outcome of the election. Small caps actually rallied. Some of the large caps got hit. Like, I get it. But there are some issues with that logic, and I'm going to show you that. So one of the aspects, as I said, COVID was the catalyst, but the outcome was sell tech. With that, we had full-blown correlation breakdown. And this is one of the things that I really wanted to bring to your attention because this is where the questions started coming in. Again, everybody, everybody's a genius after the fact, but I'll tell you what, this morning, we opened the market this morning with 101 products to the downside. Yeah, there's 101 products inside of the S&P 100. And again, I don't mind saying this. I look at the S&P 100. You look at the S&P 500 all day long, but the S&P 100, those are the only stocks that really matter, right? So we come in here with 101 stocks to the downside. And at that point in time, the S&Ps were down, about 42 points. So we turn around and the S&Ps rally higher. We end the day with a 50-50 advanced decline line. That's why I said there's correlation breakdown. And yet the S&Ps are still down, but the Nasdaq actually, it sunk lower on the trading session, which you got to realize where this leaves you. It leaves you with there's just no diversification there whatsoever. There's no way to diversify in a marketplace, where you can have a couple of heavyweights get pulled down, which is exactly what you saw today. And this is something I talked about weeks ago. It's something I talked about months ago. There is no diversification to this marketplace. And I could spend all day discussing this, because when I say there's no diversification, you realize you saw tech got whacked by the tune of almost 3%. Yeah, gold was also down. So the metals are no place to hide. Oil actually comes off hard and fast in here, which is actually, oil makes sense because with a COVID scare, COVID scare, people are not going to drive as much, they're not going to fly as much. Oil made a little bit of sense, The dollar, the dollar got bid up, minimally so, but the dollar got bid up. But I've been saying, I think the dollar's a little bit more of a fear trade lately than anything. And then here's the really perplexing part. Nobody rushed into bonds. The yields actually, when I talk about yield, I'm actually talking about like TNX. The yields, now, just nowhere really to be found today. It wasn't, the yields were actually higher on the day. There was actually some sell side activity inside of the bond market. So again, I was looking for, all right, the marketplace sells off over here, right? What's the quintessential marketplace sell off? So what do you see? Well, you see the S&Ps drop. That capital often, infiltrates pretty much to every major index product. Did you have that today? No, because you've got the Russell actually up. So the marketplace drops. People rush into volatility. We'll talk about that momentarily. They rush into bonds. Sometimes they even go into gold. You don't see any of it. This is like the most atypical, sell side activity that you've seen. And that actually is what leaves me very, very uneasy about it. Again, you know what? I have bearish positions on. I don't mind saying I have bearish positions on. And trading sessions like this, I benefit from greatly. Especially because I am monstrously short tech. A day like this, I'll take it all day long and twice on Tuesdays because, I benefit from days like this. But at the same time, listen, I'm uneasy about it. And I'll tell you why I'm uneasy about it, because there are so many different avenues that are left unexplored in here that I just don't have answers for. Again, so tech gets hit and there's no rush to bonds. There's no diversification. There's correlation breakdown. You just basically have, trades going in all different directions. And most of the time, when you see sell side activity, the market is in a harmony. Everybody sells, at the same time, and, all the algorithms hold hands and we just fire off and some selling, persists. And this couldn't be further from what we saw in today's trading session. And that's what leads me to believe that this is going to be, some rough rides. You even have, if you look at the S&P futures here, this is called Quantex. And more specifically, this is comparative Quantex. So you've actually got ticks that ended up wildly positive today with the markets down, which once again leads us to believe that the diversification is dead. So if you feel all warm and fuzzy in the spiders and somebody tells you that, don't worry, you're diversified right now. Really? Because I'm not feeling very diversified. Speaking of diversification, you look at some low risk products over here like XLU. That did actually pop to the upside, which once again, this is kind of what we kind of term like a risk on, risk off asset class. And in the XLU, which is the utility sector, they did come in and buy a little bit of the utilities today. Nothing too huge. Most of the time when you see big market sell-offs, you would also see stuff like HYG take a hit. HYG finished unchanged in the day. This is actually the junk bonds. Again, more questions than answers. Looking at the tape, it was like every algorithm, every man, woman, and child is pretty much for themselves today, firing off in different directions. Just sheer chaos in there. Nevertheless, it amounted to, again, tech getting hit. So there was this wild and again an unexpected divergence, and that actually, okay, that needs a specific look. And for that, I'm actually going to bring up this divergence in here. So this is a chart that I've actually brought up numerous times. Now remember, I'm not a market technician. I am much more, quantitative. But one of the things that I like to explain a little bit is convergence and divergence, okay? So convergence, divergence, effectively what it means. All right, what you're looking at over here, this is the QQQ, okay, versus the IWM versus the SPY. And if you've never seen it before, it's just a comparison chart. Up here is your QQQ, okay? Then we're color-coded over here. That's the IWM, and then of course the monkey in the middle over here, right there, is the SPY. So that's the spiders. Okay, just kind of you can see the spiders in the IWM pretty much right at the exact same spot. All right, what you're looking at is over the past 3 months. So the Nasdaq had diverged to the upside. A little bit of volatility over the last couple of weeks, broke it right back down. So what you're seeing is that effectively over the last 3 months, okay, everything has moved in almost perfect unison, except of course for a little bit of divergence to the upside in the QQQ, which got slammed right back down. But the one that's really surprising, almost a little alarming, is specifically today. So the IWM explodes to the upside with the Nasdaq headed down. Now, I happen to have actually that specific trade on, just to kind of delineate this. I have an index pair on, and that index pair is actually, long IWM, short the QQQ. I've also got it inside of the futures contracts as well. So I mean, this is something I've been trading for quite some time. So it's not something, I'm brand new to it and I'm looking at it. Okay, I've had this trade on for a very, very long time. What's going to be interesting is to see if this continues to play out. This would be the beginning of the end for the Nasdaq. And you have to look at this not so much on 3 months. Over 3 months, you can see they tracked pretty carefully to one another. Start looking at it over 3 years. And when you start looking at this over 3 years, now this is a 3-year weekly. And on the 3-year weekly, you just don't see anything. There's no damage really per se to the QQQ. Yeah, it got drawn down here a little bit. But the IWM has been on a bit of a tear to the upside. And what we're looking for is that these are actually going to come back to one another, and in what is going to be an absolutely wild convergence. So the only time you actually see convergences like this would be under extreme market duress. You just don't see markets coming together unless there's extreme. But today, you have to recognize how big today's trading session happens to be when you start to really break it down in much shorter time frames. Okay, they did some damage today. We're actually going to do the aggregation period of a week, just on a month. We did some huge damage today. If you looked again just over the last month, do you realize that the IWM has way outperformed, okay, the Nasdaq in the last month? And this is exactly why I wanted to bring it up, because now you start to recognize, oh yeah, I see what he's saying. The Nasdaq is totally on the hot seat. Again, whenever you look at a comparison chart, you got to look at it in multiple time frames. In the shortest time frame right now, the Nasdaq is taking the most heat, and that's why I wanted to bring that up. And I'll continue kind of delineate that over the next couple of days, couple of weeks in here. So it's a really, really unexpected. It's a convergence, but today, all right, we just diverged in directions that, as I said, more questions than answers. That should really be the title of this weekend's update over here. So I want you to look at the IWM for just a moment. And this is again where I was left, the jaw dropping a little bit. If you haven't looked at the IWM recently, the IWM is all about, okay, it's just breaching expected move. So this is actually a study called auto expected move. All right, this is the upper edge of the expected move, the lower edge of the expected move. Okay, and what you saw over the last couple of weeks, this is actually ends up, this is 3 weeks ago, we ended up right on the edge of the expected move. Last week, look at this, a vicious move to outside. That's the lower edge of the expected move there. Just a vicious break to the downside of the expected move. And I'm going to really highlight this one. So we get this vicious breach to the downside. Then we get a vicious breach to the upside of the expected move. This is huge, okay? Huge inside of the Russell. The Russell is displaying, if you will, total inefficiency in the marketplace. Okay, mark my words. This is not healthy for the overall marketplace. Why? Okay, the options marketplace is getting the Russell wrong. Okay, the options marketplace is clearly not handicapping risk effectively, because what these expected moves really are, and I'll kind of explain it this way. The expected move really comes down to the fact that this next week of trade, which ends on October 9th, it's expecting about a $5.65 expected move. Okay, what the market's saying like the last 2 to 3 weeks, okay, it's not respecting the fact that the options are priced, okay, to move $5.65. It's literally, okay, not me. The marketplace is saying, you're wrong. I'm going to move more. I'm going to move much more. And that's exactly what's going on. The IWM ripped the expected move, and it's ripping it in all directions, to the downside, to the upside. Okay, this is where we're going to start to play around with back spreads again. Then we switch over to the financials. Okay, the financials, they actually broke the upside of the expected move. Also, okay, had a hideous week last week, breaking to the downside. Now we actually bounced. Now this is where we also get into like bounce and fade, because I was talking about bounce and fade is working, and I'll come back to that here momentarily. And last but not least, you look at the QQQ. Okay, so here's another area that I promised I would talk about, was a little bit about volatility. But the Qs, you know, recognize, yeah, they got hit hard today. But did you realize that the QQQ still ended the week higher? And that's one of the bigger takeaways over here. So the Qs ended the week higher. So we're looking at this, and it's a fairly devastating day to the downside over here, but it kind of leaves something to be desired. Because I was talking about this expressly last week. I mean, this was the topic of conversation on last weekend's video. And one of the things I talked about last weekend's video, it ain't over until tech says it's over. Yeah, well, guess what? Tech might be coming around to the idea of it is over, right? And if people are looking for like a bottom inside of marketplace, you got to have these Nasdaq, this Nasdaq get really rocked to the downside. This may be firing a little bit of a warning shot. Now, I have a problem with this, okay? Because the QQQ got absolutely whacked, but where was the volatility? And I see the big spike in the volume here, but check this out. We're actually going to look at the implied volatility, okay? And looking at this implied volatility, what I'm actually bringing up over here is an IV rank, okay? The IV rank's nowhere to be found, all right? You get punched in the face by 3% and you don't even see a bump up in volatility, okay? Step back from the screen and recognize one thing. That isn't even any selling, okay? Think about that for what I'm saying for a second, because this is where everybody should step back and go, yeah, it makes a pretty good point. I see the volume picking up in here, but the Nasdaq just took a big hit and its volatility didn't come up. And that, again, that is a huge warning shot across the bow, because, again, when you start looking at the implied volatility, this thing isn't even middle of the road, right? I mean, obviously, we're in no situation like we were back, obviously, in March, in early April. Nevertheless, okay, you would expect volatility to do something over here, and it's not. It's holding its own, but this is a 3% move. Normally that would actually get, you know, volatility kind of lifting its head up. And if you're not comfortable looking at that volatility, you can actually come to studies, go add study, go volatility studies, and cruise up to like the actual implied volatility. So the implied volatility is totally flat. Look, it almost moved up a little bit today. 3% move to the downside. Again, a 3% move to the downside, and volatility barely picked its head up off the mat. Keep that in mind over here. Now, onward and upward, bounce and fade. Bounce and fade is working. Now, when I'm talking about bounce and fade, here is the idea of a bounce and fade, okay? And this is exactly what I also discussed on last weekend's update. Some sell side activity. I look for the wicked bounce. We faded it, okay? And we pull back again. And what products did I do this in? Here, no problem explaining this in any way, shape, or form. But the products we actually pulled off some of the bounce and fade were, okay? One of them I actually did was Lululemon. I had to look for products that kind of outperformed. Lulu exploded to the upside, okay? We actually turned around, faded it. It backed off today. Quite frankly, not enough. I mean, it's down like $8, but you can actually see I've got some in-out spreads kind of scattered on this. I like to scatter inventory, and I've got some pretty serious inventory inside of Lululemon, looking for Lululemon to fade back over. Now, that trade is still absolutely there for anybody that wants to, for the taking. It's an in-out spread. The next one on the docket, okay, is NVIDIA. So in terms of NVIDIA got whacked back here. Now, again, I did the exact same thing inside of NVIDIA. All right, this is a spread, though, that is, this is one that you can't jump on right now because it's already deep in the money. So I'm fairly deep in the money over here. I did not hit my exit just yet. Nevertheless, NVIDIA down some $22. And in fact, I'm short NVIDIA as well. So I like to to talk, distinctly about it. I just have a short 100 shares, but on top of it, I'm also inside of an in-out spread inside of NVIDIA. So I'm all over this bounce and fade. One of my questions, though, in here in terms of bounce and fade, okay, should we actually look at the IWM as the possibility of a candidate? And that is, the IWM didn't see that much sell-side activity, but it's ripping back to the upside. If IWM continues to be parabolic to the upside, when I say parabolic to the upside, like IWM comes up here, okay, maybe a little bit north of 160, we may have to fade that as well. I'll keep a good eye on it. And the reason I'm looking for a bounce and fade, possibly in IWM, is when you start looking at like the auto expected moves, again, that stuff is like earth-shattering, right? That expected move got breached. If it happens again, okay, in this coming week, you better believe I'm going to go in here with a bearish in-out spread. It is much easier. It is much easier to trade bearish in-out spreads than it is bullish in-out spreads. That's not a function of me wanting to be bearish. That's a function of what we term implied volatility. If you take a look at the implied volatility, all right, I'm typically buying like a 29 vol, and in this case, okay, well, and here, selling a 29 vol. Wow, the vols are crazy right now. But the point that I'm trying to make over here, okay, is I'm actually buying a volatility at about 29.1, and I'd be selling a volatility, okay, closer to like a 30, meaning that the volatility skew, in this case, is in my favor by about 1%, right? Because I would be buying here, selling here. And again, I want to label this. This would be my buy, this would be my sell. Now, if I did this on the call side of things, I'd be buying a higher implied volatility, selling a lower implied volatility. It's easier to fade the market with in-out spreads, okay, than it is to buy the market. And fade the market entails being bearish out there. So bounce and fade is back working again. LULU, NVIDIA, IWM. Last but not least on this weekend's update, expected move. Now, the expected move for this previous week, let's actually cruise over to the SPX for it. For the previous week of trade, the expected move was $87.75. Now, we hit, and I want to zoom in really tight to this, we hit every penny, okay, of that expected move. And I'm even going to go to intraday trade for a second. You really, really have to respect, okay, expected move. I want you to look back over like the last 3 days, okay? Tell me expected move doesn't make a difference. What you're actually looking at here, okay, this is the marketplace rallying and literally hitting. And again, I want to label this on the screen so that you know where it is and how to trade it. But this is the upper, okay? That is the upper edge of the expected move, all right? So the upper edge of the expected move right here is hit, all right, early on, obviously in the week, coming into Wednesday. We actually hit it, breach for a moment, pull back under it. The very next day, we actually opened on the expected move and skirted the edge of the expected move throughout the course of entire Thursday of trade. Kind of fast forwarding in here, sure, with some wicked news, we actually broke down off of it. But the upper edge of the expected move was a great trading vehicle to fade throughout the course of the week. Okay, could have been done on Wednesday, could have been done again on Thursday. And if you look, the exact same trade was in play, okay, on the opposing side in the previous week. We're actually skirting the lower edge of the expected move. So what can we expect this next week? And there's a couple reasons that I, explain about an expected move. First of all, you obviously can trade around it on an intraday basis, right? There's just no question that that is the line in the sand. The other aspect that really kind of resonates and maybe should resonate with you, next week's expected move, okay, is only, okay, what? Minimally higher. It's $2 higher. So the marketplace, okay, late this week, specifically today on this Friday, takes a big smack in the face. The S&Ps are down 22. Okay, we'll push that aside. Nasdaq is off again and off big. And yet the expected move is only $2 higher. This, again, it doesn't like leave me warm and fuzzy. This is an expected move that's just, tempting fate. What I'm saying in here is I will not, okay, sell options. Will not sell options in here. Because for my money, a $90 expected move, please. We moved 75 bucks, okay, from high to low in a day. We had another trading day this week. I mean, we exploded higher. It's all over the board. And you want me to get to sell a $90 expected move. There's just no way. There's no way that I'm doing it. Okay. And I continue to reiterate that where applicable, we're still on the buy side of options. We're using in-out spreads, okay, back spreads, outliers are where they're at. Okay, a couple of in-out spreads though for bounce and fade, but I'm not out there, okay, tempting fate by trying to sell option premium because I assume that there's a lot of volatility. I'm telling you quite the opposing. Listen, that volatility looks inherently low to me versus the type of action that you're seeing inside of the screen right now. Again, a wild end, okay, to a week that was bid up. But as I've said throughout the course of this weekend's update, I'm left with a lot more questions than answers. And we're going to see, again, if this correlation breakdown continues, we're going to see, all right, if this really unexpected divergence kind of continues where the Nasdaq starts to diverge drastically lower. And moreover, is volatility finally going to pick its head up off the mat? Because that is leaves a lot to be desired. Spike in volatility, at the very least, would be an indication that that sell-side activity was starting to make some damage to the marketplace. Because right now, we've seen a marketplace slide pretty good. We've seen some volatility, all right? But the volatility reading itself, all right, leaves a lot to be desired. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.